If you're very new to Forex and it feels confusing or overwhelming, this video is for you. By the end of this video, you'll understand exactly how Forex works, how money is made, and how it's lost, and how to place your first trade without confusion. Even if you've traded before, stay around. I'll share what I wish I knew before I started. The timestamps are below. Let's get started. Forex is simply foreign exchange. It is the global market where currencies are exchanged with one another. Every time one country trades with the other, currencies must be exchanged. And that exchange happens on the Forex market. For example, when Uganda imports goods, shillings are exchanged for dollars, the shilling being the currency for Uganda. The petrodollar system where Saudi Arabia and America decided that oil coming from the Saudis is supposed to be sold in dollars. Since then, the standard became stronger since the entire OPEC ended up trading their oil in dollars. And you know what runs economies is oil. So when Europe buys oil that's priced in dollars, they have to make sure they exchange their euros to dollars. This exchange happens every single day at a massive scale. Forex is the largest financial market in the world, by far, with over 7 to 9 trillion traded daily. $1 trillion. And that's far bigger than the stock market even, which does about $500 billion a day. As traders, we are not creating this market. We are simply participating in price movements. These movements already exist, and they're driven by global trade, interest rates, inflation, wars, central bank decisions, and other macroeconomic factors. When you trade Forex, you are not buying physical money. You are speculating on whether one currency will strengthen or weaken relative to the other. That's why you see things like euro against the USD. If you believe that the euro will rise against the dollar, you buy euro USD. If you believe it will fall, you sell euro USD. You can make money in both directions, buying or selling. It just depends on where the market decided to go and depending on the pair that you're trading. But remember this, you are trading in the same market as commercial banks, hedge funds, central banks, and multinational corporations. So your $100, it's a drop in the ocean. Discipline and risk management are far more important. When it comes to how to trade, you need a broker to be able to trade. The word broker sometimes has negative connotations. Where I come from, for example, it can mean like someone adding huge markups onto the price of something to make more money off you. Sometimes crazy amounts that are not fair. But Forex brokers are different. Forex brokers are regulated companies that act as the infrastructure, the bridge between you and the global market. And you cannot access the market without a broker. You must use a broker. Just like you cannot walk into Wall Street and buy shares directly. You have to go through a licensed stockbroker to be able to buy shares on Wall Street. So there are many brokers available. Do your research. Make sure they are regulated. I personally use HFM, which I'll mention again when we talk about placing orders on trades. Trading is not gambling. If you have a gambling mentality, trade carefully. See what I did there? If you approach Forex with a gambling mindset, the market will humble you, and very quickly. You need a method. Trading is a probabilities game. Very few consistently profitable traders maintain win rates that are above 60 to 65%. That may sound low to you, but it's actually extremely high. With proper risk management, even a 30 to 40% win rate can be profitable. You have to keep it in mind that losses are part of the business. Let's say you win 4 out of 10 trades. That's a 40% win rate. If you use 1 to 3 risk to reward ratio, meaning that you risk $1 to earn 3, 6 losses make $6 lost, and you win 4 at 3R, then the winnings will be $12. So you steal $6 in profit after losing all those trades. So a losing streak does not mean that your strategy is broken. Technical analysis and fundamental analysis may look complicated at first, but they are actually the easier part of trading. The hardest part of trading is trading psychology. If you have $100 and you risk $10 per trade, don't suddenly start risking $25 per trade just because you won 7 trades in a row and you feel like, I'm now Superman. You could give back the weeks of profit in just one single bad trade. At the same time, don't reduce your risk after a losing streak just out of fear. Consistency is what makes the math work. I'll give you an example. Steph Curry is considered the greatest shooter of all time. His 3-point percentage is around 42%. But that means he misses more than half his shots. Yet no single person ever calls him a bad shooter. I once watched him miss several shots in a row, but he kept shooting. And by the end of the game, he had completely changed the outcome. If you believe in your tested strategy, short-term losses should not shake you. Discipline beats emotion. Another thing that I can't avoid to talk about is many people say Forex is a scam. Forex itself is not a scam. It is a global financial market. Scams happen in Forex though, just like any other business out there in the world. But since it's a money business, people can easily get scammed. Scams happen a lot when People give money to individuals who are promising them guaranteed returns and things like that. Account management. Give me your $100. I'm going to flip it to 1 million. Unless you're actually paying someone to show you how to trade or stuff like that, and you're paying for a service you're getting, please don't give your money to any individual. In the Forex market, the only person that takes your money is the broker firm. And every single broker that's licensed is clearly shown when you Google it. Or you use AI. Lately, there is ChatGPT or whatever. That said, if you use a regulated broker and you trade your own account, you are participating in a legitimate market. If you really want Forex, learn it. You shouldn't be saying, how can I learn? I don't have money to pay for courses. There's free education online. It's really, really free. And you can learn this skill. It's just a skill. You can learn it. And if you learn it, you will use it forever. You'll be literally 75 or 80 years old and you're seated on your couch and you're trading the market stress-free. And you can use the same knowledge to actually trade other things like stocks and stuff like that. You'll know the technical analysis. It's easy to move steps from this Forex that you can trade with very little money to stocks which need a lot of money to trade or to buy. There are two main types of analysis. One is fundamental analysis. The other is technical analysis. Many retail traders ignore fundamentals, but fundamentals are what truly move the market. You don't need an economics degree. Just understand how interest rates work, inflation, wars, sanctions, and central bank decisions, how they affect currencies plus commodities like gold and oil. Technical analysis is the study of the charts, the candlesticks, and the price movement, and that's what most traders like to look at first. Very important, but try to understand fundamental analysis. It won't take long, the basics of it, then you can move to technical analysis. Before choosing a strategy, understand the candlesticks. There are many strategies: price action, ICT concepts, supply and demand, trend lines, support and resistance, all these amazing strategies, but none, I repeat, none is superior to the others. You should never ditch a strategy just because you lost a couple of trades. Just learn the strategy in and out. Be disciplined, keep your risk to reward consistent, follow your rules, never break your rules no matter what, and every strategy will work. In my early months, I made the mistake of strategy hopping. Every losing streak made me switch systems, and that wasted months, valuable months. Eventually, I focused on ICT concepts. ICT has a steeper learning curve because it has very many terminologies and the depth is like so high, but once understood, it becomes structured and mechanical. This is not the only way to trade. It's simply the framework that worked for me. To trade, you need a trading platform such as MetaTrader 4 or MetaTrader 5. After registering with a broker, you receive login details for your trading platform. The broker handles deposits and the withdrawals, and the trading platform is where you execute your trade. So it's not the same app. To make this clearer to you, for example, I use HFM as my broker and MT5 as my trading platform. You can create a demo account to practice without risking real money. People hear about Forex and they think they're going to have to spend a lot of money or lose their money. No. If you're curious about it and you want to try it out, you can create a demo account with a broker and then trade fake money. You're literally going to be taking real decisions in real time, but you won't be using real money. You begin to use real money on your own when you feel like, okay, I'm now ready to enter the market. It shouldn't be the stereotype of, I lost my money to Forex. Learn, and after learning, risk the money. Many traders use TradingView for chart analysis. Traders use TradingView because it is flexible. You can do a lot of things with it. But for the most part, the trading app is enough for the basic analysis that you'll need. HFM also offers a Shield 500 account, by the way, for beginners. If certain conditions are met, your initial deposit is protected within a specific period. The money you have lost is refunded back to your account such that you get a second chance to trade again. If you're interested in that, I'll leave details in the description. Let's talk about candlesticks. There's just one thing to know about candlesticks, and that's open, high, low, close, and open, low, high, close. Now, those two words are what make up candlesticks in the simple terms. Now, you'll find other confusing things. Oh, doji, gravestone, what, morningstar, like groups of candlesticks and stuff. That stuff is useful if you want to like learn much later the deeper aspects of like price action and stuff, but for the start you don't really need to like cram all those in your head. you just need to know how candles form and what candle does what. But a simple primer would be, let's begin with the open, low, high, close. Let's draw some simple candlesticks here. We'll begin from the bullish situation, and bullish means going up in simple terms, and then bearish means going down. You'll see bullish with the green candles normally. Sometimes they can be light colored like white, but normally you'll see bullish with the green candles and bearish with the red candles or black candles. But let's Let's stick to red and green for now. Bullish green and bearish red. For every candle, the idea is open low, high, close, or open, high, low, close. And in the bullish situation, which is the green situation, what we're going to look for is the open, low, high, close. And then this will be for the bearish situation, right? So this is what we're looking for in the bullish situation. Whenever you're starting, or whenever a candle is starting up, it begins by opening at a certain point. This thing you see that's a stick on the candle is called the wick, not week like day of the week, but WICK. And then the rest of the thing is called a body, like a candle body. So that's the wick right there. Now that's the candle body. Yeah, wick and body. Now, open, high, low, close. Every candle that starts doesn't start full like the way you see this one or this one. No, it always starts like this. Now, in this bullish situation whereby it's green or going to go upwards, it starts by what they call manipulation. Like it confuses you. It rarely goes in the right direction at the start. It first confuses you. It goes the opposite way and then it goes the correct way and then comes back down slightly and then closes. That's why you see the word open, low, high, close. So it opens like this from the middle, like the way this one is at, like that from there, and then it goes low, open, low, and then it goes back high, like high, let's say high from there, and then it closes by coming back down slightly. Mind you, when it comes down after initially when it comes down, remember it's opening from the middle. When it comes down from the origin, always look at the origin as the reference point. When it comes down from the origin, it becomes red. Downwards, it's becoming red, and upwards, it's becoming green. First, keep that in mind always. So when it comes down from the origin, it becomes red to confuse you, to make you think, oh, this is going to be a red candle. Yet in reality, it's going to become a green candle. So it first goes down and becomes red. Then after, it will come back up. Remember, the origin is right here. This is the origin where it opened from. So it moved from the origin, it turned down to become red, to make the low, and then it came back up to make the high. So when it goes up from the origin, it becomes green. And then in the end, it will still manipulate a bit, a little bit, to come back down and close. So that's what they call a full candle, like a candlestick. Open, low, high, close. That's in the bullish situation. And then in the bearish situation, which is down, is open, high, low, close. Bullish and bearish. This is bullish, and then the lower one will be bearish. Like bulls and bears, the actual animals. Bulls you're buying, bears are selling downwards. So that's the simple explanation of like a candlestick. So if you understand that, you're good to go, like you're 95% there. Now let's go back to the wick. When you see a wick on the bottom of a candle, it's a rejection. A candle rejects the lower part. Remember what we said. We opened from the middle here. It went down, and then afterwards it came back up and crossed the middle and then closed from here. Meaning, this price that it touched has to be indicated in a way. It doesn't go unnoticed. It must be indicated, and it's indicated by this line or the wick. You know, when you look at a candle, the top of the candle is where the flame is basically the wick, like the material that you see. It can be a thread or something, like the entire thing that has a flame on it or fire is called the wick. So the body of the candle and the wick, basically that's the same thing here. So let's so if you have something like this in the bearish situation, let's say, we can just basically repeat the same thing down here. These are indecision candles, for example, especially this one. Now this one might not be much of an indecision candle, but it still is. This one is an indecision candle. It means the candle hasn't decided where it's going. These are clearly bullish candles, even though this one is not powerful. Like when you don't see rejections on the candle, for example this one in the middle, it means there's a lot of momentum. Like the bulls are stronger, like they're very strong. There's no single rejection to the price. Like I told you, any side the price goes and leaves that price and goes back up, that part is really left as an indication. There must be an indication that it did happen. So this shows a rejection of that price point. Now if there is no candle, if it opened from a certain point like here and immediately just went up, it means there was no moving down to be rejected. It just went up, like there's a lot of momentum. So this is the meaning of this candle. But now, when you find a candle like this one here, it means there's indecision in the market, or in that particular time frame there's indecision. And if the origin was higher and it didn't go much lower, then it means there's indecision, but it's tending towards the bullish side because it's rejecting to the lower part. Yeah. Now, this is the same thing as this candle looking like that, but then something like that. It's still a bullish candle, but it has rejected majority of the bottom price, so it's moving upwards. So when you get to know that, things become much easier. And it's the same thing when you look at the bears, the open, high, low, close. Now for the bears, like we said, it's not open, high, low, it's not open, low, high, close. It's open, then you go high, then you come low, and then close. Up, open, yeah, it will open like that, and then go up. Green, remember, it will first manipulate you to make you feel like, it's going to be green. And if you're new to Forex at this point, you'll say, whoa, this is a very green candle, let me buy right away. And well, a few seconds later, it just switches on you like this, and then it turns down and becomes fully red like that. See that? So yeah, it will do something like that. So that's a open, high, low, close, to give you a bearish candle. So basically that's it when it comes to candlesticks. And when a candlestick is green like this, it doesn't mean when the market is going upwards, or when the market is trending upwards, it's only green candlesticks that will be part of it. No, like it can be trending upwards with red candlesticks in it. Let me give you an example. Now this is Euro JPY on the 1 hour time frame. Now what does this mean? It means that every single candle here represents 1 hour of time. Like that's the time frame we are on from here. This is a website called TradingView. It's very nice for analysis. The market here was trending upwards, but you can see a red candle. Yeah, so it's not like whenever you see a red candle, you mean, oh, we're going down. No, the market opened from here at this point, and then you can see that little red wick at the top. It means it first went upwards and became green initially. It became green because this is the origin. This right here is the origin. So it went up and became green. And then those that bought and bought were caught up with it because it eventually just went down and then became red. From this point downwards, it became red. Down, it became red. And then after that, I don't know if you can see, if I zoom in much further, you can see a very tiny wick down here. Yeah, it means the market went down a bit and then came up and close. So that was the open, high, low, and then close upwards. That was the one. That's the bearish situation. Same thing happened. So since the market closed from here, it means the next candle has to open from the same position, unless there's a gapping, but that's complex stuff that you don't need right now. It closed from here, and then the next hour started right at that same spot. Yeah, when it started at that same spot, it went down, meaning it first went up and rejected. It went up to this point. So if you were buying, you got some buys in, went up to this point, then it went down, and then when it came below the origin, it became a red candle. Same thing happened here and here. So now let's see, same thing happened here. Went up, came down, closed from under. But now it closed from under, and then when it opened, when the next candle opened, it went down first and then rejected that lower price. You can see the long wick at the bottom, rejected the lower price and went upwards and then closed up, and it became green, as you can see. So you can never know how a candle is going to close. That's why you shouldn't enter basing on a current candle, because it can be green. For all you know, it's going to end up red in the end. Yeah, so you can never know. And I think I can show you that from the 1 minute time frame. If you have a candle like that one, we have a red candle. Yeah, as you can see, this is another doji candle. Now see, opened downwards. Let's see if it will close from down or up. So this one has opened and gone up. It opened from here. See how it's coming down now? See, went up again. So when it moves up, there is no wick, but if it comes down, you'll see a wick on the top, and if it goes below this point here, it will become red.
Simple as that. So when you get to understand candlesticks, you can easily trade Forex with them before you think of strategies even. Yeah, it's a risky thing to do, but making yourself familiar with the market can teach you more than strategy will teach you most of the time. So learn the candlesticks first, know them by heart. Yeah, as you can see, this one has opened and pushed up to the top. Right away, there is no time to waste. It comes back down, it might become, you see, that rejection wick at the top. When it comes back down, it becomes red. So basically, that's it about candlesticks.
After you've learned the candlesticks, you go to market structure.
Let's talk about market structure. Something as simple as that. A market can move in three different ways. There's a bullish market, it moves upward. The next kind of market is a bearish market. Yeah, a bearish market. And then after that, we have what we call a ranging market or a consolidating market, and that moves sideways. And the rule is simple: trade a bullish market, trade a bearish market, never trade a consolidating market. You can easily get manipulated out here. And the easiest thing about market structure is you're following what the market is giving you. Yeah, the market is moving upwards, so you should look out for buys only. It's moving downwards, you should be looking out for sells only. Simple as that. Like, it makes everything much simpler if you do it that way. Don't try to get down here where you're not sure where it's going next. Like, you'll enter a sale here and before you know it's going up. Yeah, because it's consolidating, it hasn't decided where it's going. So I'll give you an example here. Now, down here, the market is consolidating this entire space, you see. Yeah, when you move in closer to, like, let's say a lower time frame, you'll see some movement upwards, but the higher time frame is consolidating, and you always try to follow what the higher time frame is telling you. Yeah, but now when you look, before, it wasn't actually consolidating, it was a bearish market. And that's market structure. Yeah, we talked about the wicks earlier. In a market, you always have to look out for the wick. It's what determines for you where you're going. You can start from anywhere on the chart. Let's begin from here and say we mark out this wick. You move until you reach where it stops. But remember, this is a consolidating market which is moving sideways. Yeah, so you can't see where my wick is ending there. And let's try this one here. And right there. So where else can we draw a wick? And I'm going to show you the difference between all these three versions of wicks. So this one here is not broken yet. There's something called breaking in market structure, and I'm going to explain it after. But this right here means this wick hasn't been broken, so you'll wait for until when the market taps it. Either it will sweep it, which means it will tap a wick in it and then close above. Yeah, remember closing? Yeah, it will close above, or it will tap on it and close below it, meaning it has broken structure. How do we break structure? Do you see this wick right here? This is a break of structure. When a wick is broken by a body, that's a break of structure. And then this right here is just a liquidity sweep. Keep that in mind. The only time you call it a break of structure is when the wick is broken by a body, and you don't consider the things before, you consider the things after, because there is that. You'll tell me, oh Bash, I'm seeing a wick and it's broken. How come it's not, you're saying my market structure isn't broken? Let me see the example I can give you here. Someone is like, you know what? I have my break of structure here, right? It said wick to body, right? But well, that's not a break of structure. Why? Because this wick is not breaking something in front. It's not getting broken by something in front. It's breaking something behind. So this doesn't exist. It just has to be looking at the forward part of it. So right here, there's no break of structure. This is the break of structure. The top breaks from here, and that's a break of structure. Yes, and then again we say break of structure is here, like that, continuing until the end. And then in a bearish scenario, break of structure from here. Remember, the break of structure doesn't happen with the wick tapping a candle from the back. No, the wick taps something different. The wick is right here. It's tapping the body. The wick tapping the body. Then in the bullish situation, the wick is tapping the body. Yeah, basically that's it. So in the bearish scenario, I think the easiest way to remember it is that in a bearish situation, the break of structure is below, under, not at the top. And then a bullish one, it's at the top, not under. That's the easiest way to look at it, but eventually it will become second nature. I shouldn't sweat it really. Just try to think of it that way. And then in a ranging market, like the one we're seeing down here, it's hard to find breaks of structure. You might see some, like the way we found this one, but for the most part, it's not going to happen that way. It's easier to find them up here. Like we say, there's a break of structure here. So wick, tapping, body. It's a break of structure. In a bearish situation, like we said, another break of structure is here. A wick, tapping, a body, right? Break of structure. A wick is tapping, body, break of structure. Amazing. Very simple. So, and that's market structure for you in a nutshell. But for the most part, you have to know the basics of market structure before you begin thinking of strategies and stuff like that. First, learn candlesticks, yeah, and then understand how candlesticks work. Then go to market structure, understand how the market structure works, because some people actually trade market structure fully. Market structure and Fibonacci, and they're done. Like Fibonacci sounds complex, but it's very easy. It's a very easy strategy, the Fibonacci strategy. If you have your market moving in one direction, like this, like this, like this, like this, that's the push and that's the retracement. Yeah, and then the push, the leg up, and the retracement, like that. That's how the market moves. So when someone has their Fibonacci tool, they will draw from the bottom wick of that leg, and then they draw upwards to the top of that leg. And then they'll wait for the market to retrace either to the 50% or lower, like 0.618 or 0.786. These are percentages, or they can be decimal points. The full version is 1, which is 100%. But that's the idea. This is the Fibonacci. So someone can easily trade market structure that way. Like they've drawn the Fibonacci tool. It's on TradingView and everywhere, even in every app you'll be using to trade, be it CTrader or MetaTrader 5. So from here up to here, and then you just wait for the market to move from here to come back to retrace into your zone. And if it touches here, you just enter the trade here and say, okay, I'm entering my trade from 50%. Yeah, and then I'm targeting this point. That's where my profit will be, my take profit. So, and then I have my simple 2.9R. That's amazing. If you've risked $10 here, you'll be having $29.3. If it's $100, $293 that you've gotten from this one trade. That's if you put your stop loss here right under the last swing low. Okay, that's getting more complicated, but you get the idea. Some people simply trade market structure. They don't think of strategies like complicated stuff, ICT, supply and demand, what, price action, no. And I'll give you an example of how someone can trade the market with simple market structure. There's a break of structure here, and they've seen it. They draw the fib tool up to here, the next high, and they wait for the candle to tap here. You see this 50%? And then they'll enter from there. They'll enter a sale from here. And then their stop loss is like at below 60%. And then they target this point. They target the previous high that the market has reversed from. And that's a win. 3.07 risk to reward. And you're good. You get, and that's a strategy in itself. Like, as long as you can do it consistently, and you're going to be true to it, and you're not going to give up on it just because you've lost one trade, that's a strategy for you. Like, amazing market structure, simple as it is. So let's talk about one simple example. So break a structure here to the upside. So what did you say we do with a simple strategy of market structure and Fibonacci? We draw from this point up to the high. Now the issue is knowing where the high will be, right? So you can keep adjusting it until you're sure that the market has turned finally. So let's play it, and we'll pull it down in case it didn't reach this high. Oh, it's gone actually very high. First pause. This was the limit of the high. So it went down. Remember, you can decide like always your entries. You'd say I'll always be entering on the retest of the 0.5 or the 0.618 or the 0.786. You have to be consistent. Yeah, consistency is what keeps you much longer in the market. Don't decide to keep changing your rules. You're like, oh, today let me do 0.5, tomorrow let me do 0.618. No, you have to be consistent with everything you do. That's how you'll survive. So for this case, let's say we're doing 0.5 for now. Yeah, but remember, for your risk, the closer that's the bigger the risk will be. Like if you're there, then you'll have to like leave your stop loss, so you'll be having way less, yeah, if you're entering at that point. But if you enter from like say 0 point something, and you see what you have, you have 1.58. And also keep the habit of not trying to want to get 10R. Yeah, like try to get simple wins like 2R, 2.5R, 3R, something like that, and survive with that, and then you'll be okay. And with time, as you practice, you can see that maybe you don't need to even put your stop loss down here, because sometimes if you put it down here, you realize that the market never even reaches there. It might be here. So that, then with time you can get to know, learn about order blocks and stuff like that, and know how to like modify your stop loss nicely to get like a high risk to reward. But for starters, put it below the swing low or the swing high if it's a bearish market, and then you keep altering. You say, okay, maybe I'll put my entries in between 0.68 and 0.7 always. So it's always like that. This is just one simple strategy you can employ, and it can actually make you rich in the market, because there are very many people that do that have traded for years, and they've tried all complex things, and they've decided in the end to just keep trading market structure only and nothing else. So that's something. Yeah, it's not a baby strategy or what, because you're looking at it and you think, ah, that looks so simple. My goodness, it's not as simple as you think, because technicals are not what make the market. It's consistency and following your rules.
If you've reached this point, you're really serious about this. I share my trading setups publicly on my Telegram channel, so you can see how I analyze the market before the moves happen. It is free and you're welcome to join. I'll leave the link in the description. Good luck on your journey, and I'll see you in the next video.